Good morning, good afternoon, good evening, everyone. Welcome to our third webinar on Forex trading and market analysis. I'm thrilled to see so many of you back after our previous sessions, and I hope you found the material valuable and are eager to delve deeper. So it's worth to mention that this webinar is brought to you by Aranta, which is an online broker committed to providing top-tier services. And before we begin, please note that the content of this webinar should not be construed as investment advice of any kind, because the strategies and information provided are for educational purposes only and should not be considered as a recommendation to trade. As you know, trading CFDs carries a high level of risk, and it's possible to lose all your invested capital. So please ensure you understand the risks involved and seek independent advice if necessary. Okay, so now without any further ado, let's get started with this topic. As you see, is introduction and a recap of correlation analysis. Before we jump into today's topic, let's quickly revisit correlation analysis, which we covered in our last webinar. As you may recall, correlation analysis involves examining how two or more variables move in relation to each other. In trading, this means understanding how different financial instruments or markets are interconnected. So why is this important for us? Well, recognizing these interdependencies helps us in several ways. First, it's very good for risk management, because by knowing which assets move together or inversely, we can diversify our portfolios more effectively and also mitigate risks. And also, the strategy development usage of knowing the correlation analysis is another factor that needs our attention, because understanding correlations allows us to anticipate market movements based on related assets. For example, if we know that the Australian dollar is positively correlated with gold prices, a rise in gold might signal a potential increase in the AUD-USD currency pair. So today we will build on this foundation by exploring the economic indicators and derive these correlations. We will look at how key statistics like interest rates, inflation, and employment figures impact various markets and ultimately your trading decisions. So let us start with the basics. What are economic indicators? Economic indicators are statistical data points that reflect a country's economic performance. Think of them as the vital signs of an economy, similar to how a doctor checks your pulse and blood pressure to assess your health. These indicators are crucial because they, let's say, influence market sentiment. First of all, traders and investors react to new data, which can cause immediate market movements, and also they are gauging economic health. Indicators provide insights into the current state and future direction of an economy. And also they have a predictive value, because by analyzing these data points, we can forecast potential market movements. Central banks use these indicators to make decisions on interest rates and other monetary policies. For instance, if inflation is rising rapidly, a central bank might increase interest rates to cool down the economy. As traders, understanding these indicators helps us anticipate how policy changes and adjust our strategies accordingly. In a sense, economic indicators are like a compass that guide us through the complex landscape of financial markets. And here we are going to delve deeper into some of the key economic indicators that every trader should keep an eye on. Let's start with interest rates. Interest rates are determined by a country's central bank, such as the Federal Reserve in the US or the European Central Bank in the Eurozone. And higher interest rates make borrowing more expensive for companies and individuals, which can slow down economic activity. So, lower rates encourage borrowing and investment. On the other side, simultaneing excuse me, yeah, lower rates encourage borrowing and investment, stimulating the economy on the other side. So what is the impact on currency strength? Generally, higher interest rates attract foreign investors seeking better returns on investments, which increases demand for that country's currency and can strengthen it. And don't forget that we are trading currency pairs in forex markets, so we always need a clear comparison between the policy and interest rates of different economies. So in that case, if you compare, for example, the US federal fund rate with the UK or the US, or the one in Japan, that we are going to keep it as loose as possible in their next meeting. So in that case, you will be able to determine uh, the value of a currency against another one. So the one that is really important is how the interest rates is acting compared to another economy. Example of that could be if the Bank of England raises interest rates, the British pound might appreciate against other currencies if if the conditions stay the same, as investors buy pounds to invest in UK assets. The next one is inflation rates, measured by CPI and PPI. The Consumer Price Index, or CPI, measures the average change over time in the prices paid by consumers, while the Producer Price Index, or PPI, measures the average change in selling prices received by domestic producers. And it would be noticeable to know that it indicates rising prices and purchasing power. Uh, Let's say moderate inflation is a sign of a growing economy, but high inflation can erode purchasing power. So if you have inflation in an economy, it's not necessarily a good thing, but also we need to look at its impact on purchasing power. And based on that, we will be able to evaluate the impact on currency value, because high inflation can lead to currency depreciation because each unit of currency buys fewer goods and services if the inflation persists in one economy. As an example, I can refer to the case of Japan. If inflation in Japan rises significantly, the Japanese yen might weaken, as the Bank of Japan may maintain or lower interest rates to stimulate growth, making the currency less attractive to investors. Okay, and the next one, for example, we have employment figures. One of the most important employment figures is non-farm payrolls, or NFP, employment rates. And these reports provide data on job creation and unemployment level. It's let's say employment levels are directly linked to consumer spending, which derives a large part of economic activity. So strong employment figures can lead to expectations of economic growth in the near future and potential interest rate hikes because the Federal Reserves, or let's say the policymakers, may predict the demand strength in overall economy. So they would like to control it by increasing the interest rates to control any further, uh, let's say, hike in inflation. A better than expected NFP report in the US can lead to a surge in the US dollar's value, as you have seen. It's regularly happening, especially this year, as traders anticipate a stronger economy and possible rate increases or staying at the higher level by the Federal Reserve. Understanding these indicators is crucial because they not only affect the currency markets, but also have ripple effects across other asset classes like equities, commodities, and bonds. As traders, keeping a pulse on these economic signals enables us to make more informed and strategic decisions. So now that we've covered these key indicators, we'll explore out the impact different asset classes in more detail, and we'll also look at real-world examples to see these concepts in action. If you have any questions so far, please feel free to join me and to jot them down to me. Yes, we'll have a Q&A session at the end of this webinar. So let's move on to see how these economic indicators influence currencies, commodities, equities, and also bonds. So here we are going to look at the additional key indicators. Continuing our exploration of key economic indicators, let's look at a few more that play a significant role in shaping market dynamics. First, we have gross domestic product, known as GDP, which measures the monetary value of all finished goods and services produced within a country's borders in a specific time period. It's like the report card of a country's economy. A growing GDP indicates economic expansion, while a declining GDP may signal economic trouble. Let's see how it can impact the currency market. The strong GDP growth can lead to expectations of higher interest rates, as central banks may try to prevent the economy from overheating. Okay, so this can strengthen the country's currency due to anticipated higher returns on investments. Also, positive GDP figures can also boost stock markets, as corporate earnings are likely to improve because it seems the demand and supply is going very well. If China's GDP, for example, if China's GDP growth surpasses expectations, it may lead to increased demand for commodities like copper and iron ore, benefiting commodity exporting countries and affecting their currencies. And this is what just the opposite case has happened to Australian dollar and other commodity related currencies last week, when we saw uh, uh, let's say worse than expectations and data from China's GDP growth. And then we had in the news today the Morgan Stanley analysts just revised down their prediction about the China's GDP growth to 4.7%, less than the previous one. So that means it's not a good case for commodity-related currencies, because China is the second biggest economy in the world, and they're consuming a lot of energy and a lot of, let's say, uh, commodities for their industries and for their finished products. It is like, let's say, and because of that, when we see the demand in that big economy is weakening, it's not good for commodity currencies. And the next one is retail sales data. Now, retail sales reflects the total receipts of retail stores. And this data is a primary gauge of consumer spending patterns. So we can count on it as a leading indicator for each economy. And high retail sales suggests that consumers are confident about their financial situation, which fuels economic growth in the future, the near future. But we also need to consider that increased retail sales can strengthen the economy, potentially leading to higher interest rates. And currencies may appreciate due to expectations of economic growth. And also, retail sector stocks may see positive movements. As an example here, I can mention a surge in US retail sales during the holiday season that can boost the US dollar and drive the stocks prices higher in consumer goods companies. And that is one of the occasions that you can see the stock market and the US dollar index are rising both together. Okay, the next one we have here is manufacturing and service indices. PMI service surveys purchasing managers in the manufacturing and service sectors about business conditions is another important data that can influence the whole economy, whole different market sectors, and also the currency market or FX market. Readings above 50 indicate expansion, while below 50 suggests contraction. So PMIs are among the first pieces of data released each month, providing timely insights into economic activity. We know that higher PMI readings can lead to positive market sentiment, and also strong manufacturing data may boost industrial stocks and strengthen the currency. As an example, a higher than expected Eurozone PMI can lead to an appreciation of the euro as investors anticipate a stronger economic growth. So understanding these additional indicators gives us a more comprehensive picture of the economic landscape, and they help us anticipate market movements and adjust our trading strategies accordingly. Now let's move on. That's after we've covered several key indicators, let's discuss how we can use them to gauge economic health and predict market movements. Okay, let's take a look at the predictive power of this data. First, economic indicators help us make informed predictions about where the economy is headed. For example, if inflation is rising, we might predict that the central bank will raise interest rates. So that expectations can flow in the market and then it can impact the other asset classes. If we expect an interest rate hike due to strong economic data, we might position ourselves to benefit from an appreciation currency. For example, this is what everyone was expecting last year, and that you saw that boost the gold market, and also after a couple of rate hikes, first the rate hikes actually boosted the US dollar, and after Federal Reserve stopped at the highest level at 5.5%, and then you saw that this inflation prediction got the market much higher than that. So if we expect an interest rate hike due to strong economic data, we might position ourselves to benefit from an appreciation currency. The next one is market expectations, and consensus forecasts. Before data is released, you saw analysts provide forecasts that form market expectations, and markets often react not just to the data itself, but to how it compares with expectations. So the deviation from the expectations is much more important than the deviation from the previous release. So a better than expected figure can cause markets to rally, and a worse than expected figure can lead to sell-offs. For example, if the market expects the US GDP growth of 2%, but the actual figures is 3%, this positive surprise can boost the US dollar in stock markets. Next, we have policy decisions, central bank responses. Economic indicators influence how central banks set monetary policy. First, they decide on interest rates, adjusted to control inflation and stimulate or cool down the economy. Another tool that they have is named quantitative easing, implemented to increase money supply when traditional policy tools are exhausted. And then it has a, for sure, influence and effects on markets. Policy decisions affect liquidity, borrowing costs, and let's say investor confidence, and in that way they impact the whole markets in different for different asset classes. Traders anticipate these moves to position themselves advantageously. What does it mean? For example, uh, anticipation of a rate cuts by the European Central Bank due to low inflation may lead to a depreciation of the euro ahead of the official announcement. So, as a key takeaway here, I would mention that by understanding and monitoring economic indicators, we can better predict market reactions and make informed trading decisions. So, it's not just about the numbers, but also about how they compare to what the market expects and how they might influence policy. Now, let's focus on how these economic indicators specifically impact the foreign exchange market where currencies are traded. Let's start with interest rates. Higher interest rates attract capital. Investors seek higher returns, leading to increased demand for the currency. So as long as the higher interest rate doesn't cause the economy to become unstable, it's attracting capital, especially foreign capital, to invest in the economy. So it can cause the currency appreciation. As demand rises, the currency's value increases relative to others, and traders borrow in currencies with low interest rates to invest in those with higher rates, affecting exchange rates. We call it, let's say, carry trade. For example, the Australian dollar often benefits from higher interest rates compared to other major economies, attracting investors to strengthening the AUD. And the next one is inflation, which has different impacts. First, it erodes purchasing power. So high inflation for a long time means money buys less, leading to currency depreciation. And then the central bank actions. Central banks may raise interest rates to combat inflation, which can strengthen the currency if done effectively. And this is what has happened to US dollar in the United States during past 4 years. And then it can impact investors' confidence. It means uncontrolled inflation can deter foreign investment. For example, if inflation in Turkey rises sharply without appropriate monetary policy response, the Turkish lira may weaken against other currencies. But you see, when the central bank usually takes appropriate decision or course of actions against the inflation to curb it, uh, it's gonna increase the investors' confidence in the currency. This is what again happened to US dollar last year, which investors were, uh, let's say, cheered up the higher interest rates that Federal Reserve put it uh, uh, interaction because of very high inflation. And now we see that inflation is getting closer to their long-term inflation goal, and now it's almost can be the time to cut interest rates. That can have another impact on the currencies that we will discuss later. And the next one, employment data, and let's see how it can affect the currency markets. First, it's an indicator of economic health. We know strong employment figures suggest a robust economy, so it can impact a currency value in a good way. Positive employment data can lead to currency appreciation due to anticipated economic growth and potential interest rate hikes or staying rates at the higher levels. And also, let's say, it reflects the consumer spending is going very well because more employed individuals mean higher consumer spending that fuels future further economic growth in the near future. So as an example, let's say a significant drop in the UK's unemployment rate might strengthen the British pound, as investors expect the Bank of England to consider tightening monetary policy. So why this matters to traders? There are a couple of reasons that we really need to pay attention to all of this data and their impact on the currency markets, because volatility around data releases is the first cause of employment data is the volatility. Employment reports like the U.S. non-farm payrolls, that's I'm pretty sure that all of you have heard about that, and many of you might try to let's say trade that. Uh, it often causes significant short-term volatility in currency pairs, and based on my study in Euro USD in past 5 years, it has an instant impact of almost 75 pips, that volatility in the currency pair. And then it can create trading opportunities, because understanding these impacts allows traders to capitalize on market movements or protect themselves from adverse effects. And also, it's very beneficial to know because of the way it can impact our risk management. Being aware of coming economic releases helps in adjusting positions and setting appropriate stop loss orders. And as an actionable tip here, I would mention always check the economic indicator uh, in economic calendars for key data release dates and times. You can always use the Aranta's economic calendar on the website you have. Plan your trading activities accordingly to either take advantage of the potential volatility or to avoid unexpected surprises. That we'll get to that maybe later in this webinar. And now, moving on to commodities, economic indicators can also significantly influence the prices of resources like oil and gold. I brought only two examples of that because I know most of the forex traders are usually focused on oil and gold. So let's get through oil. First, there is a demand driven by economic growth impact. Oil is a primary energy source in the world, even though the governments are trying to make everything green, but still the oil is a primary energy source. A strong economic growth increases demand for this uh, energy commodity, and it's influenced by global indicators. Indicators from major economies like the US, China, and the Eurozone can impact oil prices. That's the reason you see the oil market usually, let's say, reflects or reacts to data releases from major countries, especially the China, because the China is the biggest energy consumer in the world. They consume uh, standalone 50% or around 50% of the whole energy supply in the world. So geopolitical factors is another, let's say, important factor that impacts oil market. While not an economic indicator, know that geopolitical tensions can also affect supply and consequently prices. For example, positive manufacturing data from China can lead to higher oil prices and vice versa. And negative manufacturing data or negative consumer spending and any negative economic data from China can lead to lower oil prices, which has happened last week due to anticipated, let's say, decreased industrial activity and also energy consumption. And then there is a gold. I know many of you like trading gold. Yeah, we know gold has a safe haven uh, asset role. Gold is often bought during times of economic uncertainty or geopolitical tensions or inflationary environment, and it's inversely related to economic strength. When economies are strong, investors may favor higher yielding assets over gold. That's what we call as a risk aversion. It means when everything is going very well, people are more comfortable to take higher risk. So they usually exit gold market and turn to another more riskier assets like the stocks. So higher interest rates increase the opportunity cost of holding non-yielding assets like gold, potentially lowering its price. So it's very important. So one of the key factors that that is benefiting gold these days is all of these expectations and speculations about the maybe more aggressive rate cuts coming by Federal Reserve in their upcoming meeting. So that's why, because higher interest rates increase the opportunity cost of holding non-yielding assets like gold, and gold is considered as a non-yielding asset. So higher interest rates, it means the higher opportunity cost. So if they lower the rate, it means is whether to keep. It's not that they make keeping gold cheaper for investors, and that can boost the demand for gold. And this is what is happening right now in the market. As an example, we know during economic downturns or when inflation fears rise, gold prices often increase as investors seek to preserve wealth. And also the transmission mechanisms affecting commodities. First of all is currency movements. Commodities are typically priced in US dollars. So a weaker USD can make commodities cheaper for holders of other currencies, increasing demand. And also next is inflation expectations. Higher inflation can lead to increased demand for tangible assets like gold as a hedge. Then we have market sentiment. Uh, which is very important factor because positive economic indicators can boost investor confidence, affecting commodity prices differently depending on the asset. And there are many different implications for traders based on the trend and the direction of the data. For example, one is diversification. Including commodities in your portfolio can provide diversification benefits. Then it has the correlation with other markets. Understanding how commodities correlate with currencies and equities can help in strategy development. And keep an eye on indicators that specifically impact commodity markets, such as inventory reports or let's say some sector specific data, and use economic indicators in conjunction with commodity specific news to inform your trading decisions in the commodities market, and then you can follow the trend on the commodity related currencies. So now that we've seen how economic indicators impact currencies and commodities, we'll next explore their effects on equities and bonds very shortly. We'll also look at real world case studies to illustrate this concept further. As always, feel free to note down any questions or thoughts you might find that these interconnections open up new perspectives on how you approach trading. Now, let's shift our focus to the equities market and explore how economic indicators influence stock prices. Okay, first is interest rates. Higher interest rates increase borrowing costs. Okay, what does it mean to equities? Companies often rely on loans for expansion and operations. And when interest rates rise, the cost of borrowing increases. So this can lead to reduced corporate profits due to higher interest expenses. And higher borrowing costs can result in lower earnings forecasts because investors may perceive stocks as less attractive compared to bonds with better yields. I mean, their condition cause this, and stock prices may decline as a result. So if we want to turn into investor behavior, we see investors might shift capital from equities to fixed income securities, seeking safe returns. For example, when the Federal Reserve signals an impending rate hike, sectors like real estate and utilities, which are sensitive to interest rates, often see a drop in stock prices. And next is economic growth indicators. First, positive GDP and retail sales data indicates robust economic activity and consumer confidence. They suggest higher future earnings for companies. So investors are more likely to buy stocks when they expect companies to perform well. And that leads to increased demand for equities, driving prices up. So if we want to scrutinize the sector performance, cyclical sectors like technology, consumer, discretionary, and industrials may outperform during economic expansions. As an example, I would mention strong retail sales figures that can lift the stock prices for companies like Amazon and Walmart as investors anticipate higher revenues in those companies. So why this matters to us as traders? Because first, earning expectations, economic indicators help forecast corporate earnings, influencing stock valuations. And then market sentiment. Positive indicators can lead to bullish markets, and negative indicators may cause bearish trends. So in that case, we need to gauge the market sentiment if we want to trade in an instrument. So, and then the next one is investment strategies, because traders can adjust their portfolios based on anticipated economic conditions, and that would be a very wise idea to, let's say, monitor all of these developments to make a very educated, let's say, decision, and keep an eye on key economic releases that impact sectors you invest in. Adjust your equity positions accordingly to capitalize on or protect against market movements. And there is for sure impacts on bonds as well. So let's delve into how economic indicators affect the bonds market, starting with interest rates. There is an inverse relationship. We have to recognize that. When interest rates rise, exiting bonds with lower yields become less attractive. So bond prices fall to adjust yields upward, aligning with new higher interest bonds. So that impacts, and there is an impact of rate hikes. To explain it, I would say uh, expectations of higher future rates can lead to immediate selling of existing bonds. So this increases yields across the bonds market, because there is a inverse relationship between the bond price and the yields. So if the central bank raises interest rates to combat inflation, government bond prices may drop and yields will rise. Okay, so the next one is inflation, the impact of inflation on bonds. It erodes real returns. We know inflation reduces the purchasing power of fixed income payments. In that case, which means the bond holders are getting less real interest. Investors demand higher yields to compensate for inflation risk, and that impacts demand, because high inflation can decrease demand for existing bonds, leading to lower prices and higher yields. As an example, rising inflation expectations may cause investors to sell long-term bonds, anticipating that future interest rates will be higher. And then there is a transmission mechanisms. First, monetary policy response, because central banks may raise interest rates to control inflation, affecting bond yields as well. And investors expectations gonna change, because anticipated changes in economic conditions influence bond market dynamics as well. This is what we know, the reaction of the bond, or the relation between the, for example, short-term and long-term bonds, is a leading indicator to determine, or let's say to time, the recession, economic recession or growth, something like that. And then there are many implications for traders. First of all, is portfolio management. Understanding these relationships helps in managing interest rate risk, and also yield curve analysis. Changes in the yield curve can signal economic shifts, guiding investment decisions. And here is an actionable tip for traders. Monitor inflation, the central bank policy statements to anticipate movements in bond yields, and adjust your fixed income investment accordingly. Now, let's delve deeper into transmission mechanisms, because it's very, very important, because it's somehow it sounds like shifting in the narrative of financial markets in different asset classes. So understanding the transmission mechanisms is crucial for grasping how economic indicators influence different asset classes. Monetary policy, let's get through the monetary policy. Central bank actions. Central banks adjust interest rates and use other tools based on economic indicators. And these actions influence borrowing costs, consumer spending, and investment in the whole economy that can impact all markets. Changes in monetary policy can lead to immediate reactions across currencies, stocks, bonds, and commodities. As an example, a surprise rate cut by a central bank can inject liquidity into the economy, boosting the stock markets, but potentially weakening the currency. And this is what happened just after the pandemic. If you remember that the Federal Reserve injected a lot of money, they increased the supply of money in the economy, and that boosted the whole industry and took all the US major indices to the new historical highs. And then let's say it creates expectations and speculations around all of these transmissional mechanisms, because first, market anticipation playing a very, very crucial role here, as traders often make decisions based on expected future economic condition. This is the main difference between the stock markets or financial markets and the goods and services market, because in the goods and services markets you are let's say you're trading the past accumulated work. Okay, but in financial markets, you are buying or selling the future, and everything is spinning around the, let's say, the speculations and anticipation and expectations. Okay, so markets react not just to actual data, but to how it compares with forecasts, and then it can cause price movements. If data exceeds expectations, markets may rally and let's say corrects itself. If it falls short, markets may decline to correct itself again. So if inflation data comes in higher than expected, investors might speculate that interest rates will rise, causing bond prices to drop and yields to increase. And there is a cross-market, there are cross-market effects. Let's say interconnected markets is the first thing that this is the first string to follow the these cross-market effects of all of the transmission mechanisms. The movements in one market can influence others due to global financial integration. So it has impact on currency and trades around the world, because a strong domestic currency can make exports more expensive for the country and affecting the profitability of export-driven companies. In that case, changes in commodity prices can impact currencies of commodity exporting countries, and that can create a very great trading opportunities for traders. So, as an example, let me add, an increase in oil prices, for example, might strengthen the Canadian dollar, as Canada is a major oil exporter, while simultaneously increasing production costs for manufacturing companies. So in that case, if you, for example, monitor the trends of oil, you can be able to speculate on Canadian dollars trends as well. So you see, one might ask, why understanding transmission mechanisms matters? As I mentioned, first, because of comprehensive analysis. It helps in anticipating how changes in one area can ripple through others. And then it can take us to a strategic decision making, because it enables more informed trading and investment choices across different asset classes. And also it has a very good impact on risk mitigation efforts, because awareness of these mechanisms aid in managing potential adverse effects on your portfolio. So as an actionable tip, I would say always consider the broader impact of economic indicators. Analyze how a change in one market could influence others and adjust your strategies accordingly. So here is a very short case study I brought. Let's apply what we've learned with a real world example as a case study, which is a US non-farm payrolls release scenario. The NFA report shows that the US economy added 250,000 jobs last month, for example, exceeding the forecast of 180,000, and unemployment rates drops from 4% to 3.8%. This is a scenario of the last year. So what was the market reactions? There was an immediate impact. The US dollar strengthens against other major currencies, and traders anticipate that the Federal Reserve might consider rising interest rates sooner. And the currency pairs affected by this data release were Euro USD, GBP USD, and USD JPY. And during these stronger than expectations NFP releases, we see the strengthening of US dollar that can make a great decline and as USD appreciates in Euro USD and GBP USD. So on equities, usually better than expected NFP has a positive effects on equities because it boosts positive sentiment in the market. The stock markets may rally due to optimism about economic growth, and investors expect higher consumers spending, boosting corporate earnings. And then there is a sector impact as the cyclical sectors like retail, technology, and manufacturing may see significant gains. And it has also impacts on bonds as yields increase. Bonds prices fall as investors sell bonds in anticipation of higher interest rates. Yep, higher interest rates, and the yield on the 10-year Treasury notes may rise. So before major data releases like the NFA, review consensus forecast and plan your trading strategy. Decide whether to trade the event or wait until after the volatility subsides. Okay, and here we have a practical exercise. Let's put the theory into practice with the practical exercise on interpreting economics data in real time. Here are some steps I recommend all of you to do. First, review the economic calendar. Identify economic release. For example, let me get to maybe yeah, if you see my screen, it's the aranted.com, and here in Tuesday you can always find economic calendar here. It's coming from MQL5. It's a reliable one. So you have the actual let's say column here, forecast column here, and previous column here. So any data which is released can impact the currency market based on the currency you see mentioned here. And you have the time, so you will be able to plan your trade. uh, First, this you can say it's a reliable economic calendar, okay? But there are plenty out there like a Forex Factory or investing.com. So note high impact events for the week, such as GDP releases, employment data, or central bank meetings. And uh, for example, this is a one here that can get you through the MQL, but also let me show another calendars. One of my favorites is investing.com calendar. And here, first you have a filter there. You can select all the economies or let's say the countries you want to review all the data from them, because maybe you are trading or planning to trade their currencies. And then here you are, you have the first time, the currency, the impacts, the importance, let's say, and the name of the event, the actual forecast and previous data here. And it's very easy to use and very easy to understand, because now when you see there's a three stars uh, events, it means they are very important to the market. And so far we don't have any for today, but if I go to tomorrow here, you will see there is a core retail sales for the US that tomorrow 15:30 GMT 3 plus will be released, and it can impact the US dollar for sure. And then analyze the consensus forecast versus previous data. Understand market expectations. Look at the forecasted figures and compare them to previous results. Then consider the potential implications of results being above or below expectation. For example, if you see the market is expecting the new data comes below the previous, let's say, release. So in that case, first, the market is expecting the cooling down for US core retail sales. And here, if I open it up, I can look at the previous data and compare it with the each actual with the previous to see how it's working. And also, you see there is something like a chart, and this is a bar chart, very helpful. And you see it's been mm, it's not very it wasn't in a very organized way, but uh, there are plenty implications that that let's say showing that the uh, core retail sales uh, is decreasing somehow from the level of 2.4% growth to, let's say, 0.4%. It means the real economy is under pressure. So that would be another uh, cause to put more pressure on Federal Reserve to maybe cut the rates. So look at the forecasted figures and then compare them to previous results to understand the overall trend of the data, and then consider the potential implications of results being above or below expectations. And you can always find it here, as they see it's stated that core retail sales measures the change in the total value of sales at the retail level in the US, excluding automobiles, and it's an important indicator of consumer spending and is also considered as a pace indicator for the US economy. So what is the impact? A higher than expected reading should be taken as positive for the USD, while a lower than expected reading should be taken as negative or bearish for the USD. So the next step is developing potential trading scenarios. If data exceeds expectations, you should have a plan for that. Markets may react positively, consider strategies to capitalize on this. If data falls short, prepare for potential negative market reactions. Maybe you can consider some strategies to capitalize on that fall as well. And if data matches expectations, usually market reaction may be muted. So you can plan accordingly. And the fourth step is post-release analysis. Immediately after the release, check the actual figures, observe initial market reactions in various asset classes to understand how the overall trend is changing. Because if you see a notable change in the overall trend of the data, it means the economy, or in a set of data, for example, all the macro economics indicators may change in one direction. That means the whole cycle of the business is changing, or the economy is at its turning point. So you may need to plan your trades accordingly. And in the SF5, observe and interpret market reactions. Note changes in currency pairs, stock indices, bond yields, and commodity prices, because and now you know how they are interconnected to each other. And then try to identify correlations. See how movements in one market may affect others, and then adjust trading strategies. Based on your analysis, decide whether to enter, adjust, or exit your positions. Let's get through an example scenario. Let's say there is a UK inflation rate announcement, and the forecast is 2.5%, the previous was 2.1%, and the actual is 2.8%. Let's get here to our calendar to see how we can plan it. Let me just clear everything. Find the UK. This is also a way if you want to find a specific data point or a specific releases for a particular country. So in that case, you can just find your country like this, United Kingdom. I don't want the less important data, and that's it. And you are the data released this week, and you see this time the CPI came just as it's not it's not been released yet, but this week we expect it. So here, for example, if data comes higher than the previous one, higher inflation increases the likelihood of an interest rate hike by the Bank of England, or they may keep the rates higher for longer. And higher rates can increase borrowing costs, potentially impacting corporate profits. So that can have, let's say, negative impacts on the stocks. And then anticipation of rate hikes can lead to higher yields for bonds. So as an actionable steps, if you are forex traders, as a forex traders, you can consider going long on GBP pair, expecting currency appreciation because of the higher than expected inflation, because that is a signal that the central bank is going to keep rates higher for longer. But if you are equity trader, reevaluate positions in interest sensitive sectors. And as a bond trader, adjust portfolios in anticipation of yield changes. So as a key takeaway here, we have this preparation is crucial. Being aware of upcoming data releases allows you to plan and react effectively. Then understand the data. Knowing why the market reacts helps you make informed decisions, and then stay flexible. Be ready to adapt your strategy based on actual market conditions, because no one can anticipate 100% right all the time. Okay, so as we wrap up this section, remember that integrating economic indicators into your trading strategy is a powerful way to enhance your decision making. So, by staying informed, analyzing market sentiment, and employing robust risk management techniques, you position yourself to navigate the markets more effectively. So feel free to prepare any questions you have, and let's continue to deepen our understanding together. Perfect. Finally, I'd like to extend a heartfelt thank you to each of you for joining today's webinar. Thank you so much for your active engagement and thoughtful questions have made this session enriching for everyone. Remember, trading is a journey of continuous learning, so stay curious and stay informed, and don't hesitate to reach out if you need any support. Thank you so much, and let's wrap up this session. Thanks a lot. Have a great evening. See you next time.